All right, so we have the pleasure today of having the president from Retirement Insights joining us today. With over 25 years of experience across financial services, he'll be sharing a deeper look into some of the market trends that Kevin started to share earlier today. Please help me welcome John Guido.
I don't know about everybody in the room, but I was feeling really good about myself until you talked about those scholarship winners, and I thought, oh my God, what an underachiever. But we'll muddle through. For those that know us, it's going to be a lot of content, a lot of data, a lot of facts. I'm going to try not to give you death by PowerPoint, so if there's questions, ask. I'm going to try to skip through the themes. I think you guys are in a really good place, and there's a lot, as Kevin said, there's a lot about margin pressure, but there's tremendous opportunity, right? The small market is completely underserved. Participants obviously aren't saving enough. To me, that seems like a negative to some people. I think when you're in the business, there's lots of opportunity there, right? So with that, a couple of things that this is, okay. As I said, growth will continue in the DC space. Small markets underserved. Advisors are evolving. You're going to see some data on the K and the B side. Obviously, specialist advisors and RIAs are coming down market. And I think in particular in the B space, there's some changes that might be of interest to you. Providers. Kevin mentioned earlier about margin. No sponsor is buying on price anymore. And it's not for any other reason, I think, based on the surveys that we do and the research that we do, that they already believe the providers in the space are all around the same place when it comes to dollars and cents. And there are times where some folks will cut price. That comes out in the process. So cost is actually way down on the list of things that they identify as the reasons why they're leaving or buying. They're leaving because of service. This is fresh data that we have. Okay, across the market segments, they're leaving because they're not happy with where they are. With where they're going, at the center of the conversation is the participant. And not, I have a cool widget on my phone, I've got a nice tablet type of thing. It's throughout the conversation, it's clear with who they're doing business with, the participant, and getting them better ready to retire. It has to be centric to the conversation. A little bit of just context for those that don't know us. We are basically a research and consulting firm. We focus entirely on the retirement space. Up here on these screens are some of the logos of some of the firms that we either do research or consulting for, or we profile. So from you guys to TIA to Fidelity, ADP, Hancock, Lincoln, on and on. The major providers are who we're doing business with. That's why the data that we have provides the value that it does. In terms of state of the market, as I said, DC growth will continue. We'll get into a little bit of details of that. Anticipating drawdown means out into the farther years, you'll start to see distributions really taking off. That's not a matter of what's been historical issues with the economy. It's a matter of an aging population, and you'll see that. And then lastly, small business, as I said, is underserved, and I think there's a lot of opportunity there, and I want to hit on that. Retirement, this is just an overview of the market. This is 10-year CAGR up to now is a 6% growth. Okay, and what you'll see, the blue is representing K at 6% growth. The large orange is IRA, which is the biggest asset total of 7.3. The purple color, I guess, is 403B. And then SEP, Simple, and Solo K represents the gold sliver, which is the highest uptick in percentage. It's working off the lowest base, but there's also been sort of a surge over the last couple of years in the micro market segment. So just for context, right, over the last 35 years, DC plans have doubled, while DB has gone down 69%. I don't think that's news to anybody. In terms of cash flow, the last 3 years, DC plans experienced a negative cash flow. That's starting to reverse itself. Essentially, the market conditions and withdrawals. Current data tells us that while withdrawals are still exceeding contributions, that gap narrowed recently. And then on the DB side, both private and public sector has been negative in terms of cash flow. So as Kevin mentioned earlier, DC is clearly where it's going to be for retirement. Continued growth in the DC market. Participant growth, this is all DC plans, so this cuts across K and B and so on, is 2%. We're projecting about a 5 to 6% asset growth over the next couple of years. The K plans will have clearly the highest growth rate, and plan turnover is going to account for most of the sales, although you'll see some statistics next. In the micro segment, we're estimating about 23,000 plans will be formed this coming year. So this is a bit of an eye chart, but at the very top is less than $1 million in assets. Very bottom is over 250. Projected turnover rate is anywhere from 6 to 6.5%. If you're below 10 million, that's where the majority of plans are going to turn over. It's roughly 41,000 plans in total, on top of which will be those startup plans that I mentioned earlier, again, about 23,000. In terms of assets, the switch rate that's going to be the highest is between the 50 and 250 asset space. Okay, that's gotten more competitive, obviously, as folks have traditional small market players have moved up market a bit. This is what I was mentioning earlier, accumulation, a shift from accumulation to drawdown. So at your far left is 1960. That gap was nice and wide. The top line was those people in prime accumulation stage, active workers saving. The bottom line was folks in a drawdown stage, 65 or older. Sort of at a midway point on this chart is 2000. Top line, 21% of the population accumulating, 12% in drawdown. The gap started to narrow to about 8 points. As you go out to 2020, that's about a 9-point spread. 2014, based on demographics, that narrows to 2 points. And then we're thinking at around 2016, they meet. Right, and those that are drawing down are touching those that are accumulating. That's the point. In between, we're going to obviously have economic downturns and upturns. That's going to affect withdrawals. Typically, they spike on the years that follow a down market. Same thing for contributions. And as I said, we're seeing data now that would tell us in the last 6 to 12 months that gap has narrowed between contributions in and distributions out, lower distributions. Fee trends. This is an eye chart, right? So anyone that has questions for this separately, I'd love to have a conversation around it. I think what we ought to take away from this, especially down market, is fees have been constant the last several years, right? So the provider community has figured out a way to do lots of stuff for sponsors and participants without essentially raising fees. Of course, this cuts across providers, it cuts across segments. So for the sales folks in the room, I think what you want to be having a conversation with a client about is value. Because from the outside in, and I would say this for you all as well, I don't think the provider community has done a great job of talking about value, right? We get into a conversation of cost. To some degree, the industry, the provider community has driven some of that themselves, but the sponsors will understand value when it's explained to them, right? There's been feature functionality that all of the provider community, in varying degrees, right? There's competitive advantages and differences between firms, but things that drive plan health and participant outcomes have really been added into every one of the major providers' capabilities over the last several years while holding fees relatively constant. that doesn't equal value. I don't know what does, right? That coupled with the fact that sponsors are saying, I'm leaving because of service, I'm going because of the participant experience. There's a story there. I think the provider community has to be less humble about telling it, right? So for the fellow salespeople in the room, I get it. I don't want to. I know clients always want to talk about fees and cost. It just doesn't have to be the first thing that comes out of somebody's mouth. Fiduciary services. You can't have a conversation today nowadays without talking about fiduciary services. This gives you a sense across our database. We profile in total 70 401k and 403b products. What does that mean? That's the major providers, all of their products by segment is included in this database. And today, almost 80% offer 321, 60% offering 338. Those numbers obviously are only going to rise. This echoes the EBRI stat that Kevin just mentioned earlier. Retirement account ownership is down. So again, a bit of an eye chart, but what I would draw your attention to is this is saying, and this has not come back since prior to 2008, the recession, 50% of folks interviewed, this, by the way, is from the Federal Reserve, okay? 50% have no retirement assets at all, okay? The bottom comment that I would draw your attention to, and this is a little more scarier, folks that are close to pre-retirement, retirement age 55 to 65, 40% are saying they have no retirement account ownership. Okay, so could be viewed as negative, a little bit scary, but clearly healthcare is going to drive life expectancy, right? And people already do not have retirement accounts. For those that are in the business of selling products and servicing them, to me, that seems like opportunity. Small business, as I mentioned earlier, underserved. Again, just to give you context, less than 20% of private sector companies with 100 employees or less have any type of retirement program in place. Okay, contrast that with 88% of those over 500 having a retirement program. On the right-hand side, this is net between 2008 and 2013. 12,000 DC plans were added. So obviously it's sales in, discounted by companies out of business, purchased, combining plans and that type of thing. From 2003 to 2008, it was 93,000. Okay, so sounds like a big number as a standalone, but this reinforces that less than 20%. There's a lot of opportunity for sales.
John, just a question.
Yep.
How are those plans going to be served? I mean, we obviously have a significant advisor force here, and so we're looking at that as potentially an advantage for us to serve plans just like these. Is that how you're seeing those plans served, or is there another way that those plans are being served other than advisors?
So the question is, how are these plans going to be served? The answer is, I think we'll see some exodus of advisors, but I don't think in large scale based on what we're seeing, and we're going to have another actually advisor survey coming out in the next month or so. So the short answer is yes, they'll still be continue to be served by advisors. We have not seen a consolidation that was sort of rumored and talked about in the TPA market for a number of years. Doesn't seem like they're going anywhere. That's current data. And lastly, and I'll touch on this if there's time, I think the startups of Robo and some of the tech firms, it's interesting. It could be a bit of a market disruptor, but this next slide tells you you can't serve sponsors and participants without distribution and service. You just can't do it, right? And these market disruptors, another eye chart, basically says that to give you some context, the robo advisors that are listed here, Betterment, Wealthfront, Trade King, and so on, combined are half of what Vanguard's personal advisor business is. Okay, to give you some context, text-based, lack of services, lack of distribution, sort of in a box type of activity, but charging anywhere up to $120 a month for that service. Okay, so it's not exactly inexpensive. And then lastly, you have the state-run plans. There's an additional one, Massachusetts, but there's currently talk in the Senate about rearranging that. So we'll see where state-run plans go. So I think back to Kevin's question, I don't think this in any time soon there's going to be a lack of advisors and a lack of providers servicing the community. So key considerations, obviously benchmarking is going to continue, but I think the next horizon really is pricing for reasonableness. It's in the eye of the beholder, but I think sort of like 404C, do you have a process in place with some rigor that you're regularly looking at how you're pricing not only prospects, but existing business, right? Are the prices reasonable? Service quality and value is sort of in vogue again. We touched on that. It's nice to know that the next segment is about education, because engaging folks and keeping them engaged is going to be critical in plans. Data security, it's another thing that sponsors are concerned about. To what degree, who knows, it might be based on what they're reading, but I would imagine that in your RFP responses, and I know someone in the middle was identified as in the RFP group, you'll see more and more about data security. And then lastly, to the question about advisors, there continues to be a shift towards the specialist advisor. They've also moved more heavily into the 403B space, and I think we'll see more of that coming up. So advisor trends. This is the case side. 65% say they write at least some business as an RIA. This supports the specialist comment that I made earlier. 63% describe themselves as mainly fee-based. That's up from 24% since 2005. Significant uptick. 81% think of themselves as a fiduciary. Keep in mind this is before the regs even get enacted, okay? So clearly it's how it's being presented to a sponsor. And interestingly, in the lower end of the market, think sub 10, certainly sub 5, more than half of the business goes unbundled with a TPA. That number has actually upticked over the last couple of years. So I don't think that the predictions of TPA consolidation are coming true. This is share of key variables. The bolded ones I would kind of draw your attention to. Left-hand column is a non-specialist. That's an advisor who gets less than 20% of their income in retirement. The middle column is emerging specialist, less than 60% of their income. And to the far right is a specialist advisor that's more than 60% of their income comes from retirement business. Okay? So a couple of things I draw your attention to. Those non-specialists, those earning less than 20% of their income, a year, 45% of advisors in the space. So not quite half, but pretty close to half of the advisors. Lower right-hand corner, and this is upticked regularly over the last 5 to 10 years. The specialist advisors now accounting for half of the sales, plan sales, and better than 60% of the asset sales. Okay? So snapshot, I think, tells us going forward, a little bit of a prediction back to your point. I don't think that the two plan Tonys, blind squirrels, whatever you want to call them, down market are going to exit the space anytime soon. They're going to still be in the space and have to be serviced. 45% is a big number, but clearly in the retirement space, the retirement specialists are driving asset sales, they're driving plan sales, and they're coming down market.
Is this demographically the only information on
where they sit?
Well, not where they sit, but how old been a perception that there's a graying of the people that are really specialized in the state market. And what happens 5 years from now when some of those folks go back to the
So the question is about the demographic of the specialist advisors and getting older. I could give you more specific data on that, but I think generally that's a way out. And what we're also seeing is with the specialist advisors, they're building their practice with new team members. Okay, so I'm not so certain they're going to exit the business as quickly as people were thinking they might. Is the short answer. Channel affiliation, I think really what to take away from this is insurance, how an advisor identifies their affiliation. Insurance entity is down, wirehouse is down, IBDs and RIAs are up. Okay, so clearly just another look at the specialist and the RIA, there's a greater affiliation towards those broker-dealer entities.
John, that's just the specialists on that chart? Or is that all advisors?
This is all advisors.
All advisors.
Yep. And this next slide goes to, and you know, some of this can be, I can get to you and circulate it if people are interested in reading through it. But what this goes to is non-specialist at the top, specialist at the bottom. The real takeaway here is if you're a non-specialist, they essentially need help doing everything. And anyone who's facing off either internally or in the field with advisors, I see heads going up and down, know that that's going to continue. The specialist is all around outcomes, right? So plan reviews, fee analysis, periodic enrollment group, enrollment meetings, those types of things. So service at the participant level versus the non-specialist's service me. Okay. Now we all know the specialist doesn't want to be ignored either. They already expect you to be servicing them, but their focus on a deal by deal basis is what's happening at the sponsor and the participant level. And we track this annually. So just if anyone's wondering kind of where the data comes from. We interview somewhere between 600 and 700 advisors a year. We've been doing it now we're in our 11th year. We've estimated that looks somewhere like 12 to 15,000 advisors representative in the marketplace. And to keep it fresh, but also to have trend data, we cycle folks out. So we will keep advisors in year over year to make sure that we have trend data and we're not chasing shadows. But we will also enter in new advisors to get a different perspective on the same questions. Plans sold less than 12 a year on average. Sort of in the middle, the larger 1.8 and 3.2 tells you that less than $1 million plans, it's 2 to 1 sold unbundled to bundled. That evens out. That 1 to 1 that you see is when you get above 3 million. Right, so this is just a little bit of detail that goes to the service stat that I passed along earlier. Importance of RIA. Think about bottom bar is 2011, top bar is 2015. The numbers don't matter as much as the takeaway that the RIA business, whether I wrote it as a hybrid or a full RIA, is continuing to grow. Right, so you could see just by the graph the growth in the last 4 years. That's a trend that's not going away. This is B trends. It might support a little of what was touched on earlier. K through 12 loses the top spot in focus. This is just a survey that came out of the field 2 months ago. The non-specialists primarily focused on the not-for-profit and healthcare, specialist, public higher ed, and private higher ed. But I think the headline is they've moved away from K to 12 as the primary focus. A couple of other trend highlights. 77% of the advisors servicing the B space consider themselves a fiduciary. That's up from 52% only 4 years ago. 50%, I thought this was kind of surprising or believe that the regs will make their practice more attractive. So the data tells us they're embracing it, not embracing it. Books are growing. 2016, 123 million on average versus 78 in 2012. Interestingly, 41% emphasizing B for growth in their practice versus 12% same time period in 2012, which is the last time we did this, and lower than their K counterparts, but a third of them consider themselves mainly fee-based. Okay, so just some context as you're working with advisors across markets and nationally. So this again, B service model. I think that sort of the light blue is multiple providers. The middle blue is single provider that packages everything, and the dark blue, multiple providers with provider offering plan administration and aggregation services. Clearly, that's up most dramatically 2012 to 16. Right, 2012 is the bottom bar, 16 is the top bar. So another sort of interesting takeaway that we found as a highlight. Couple of minutes, or yeah, okay. And again, as a B, writing RIA business, 12's at the bottom, 16's on the top. That's up over 20 points to 77% in the last several years. So the RIA thing is taking hold in the B market like it has in the K market. I'm going to just kind of wrap up with this quickly. We did last year a voice of the participant survey. So this is talking directly to participants and what their views were. 69%, this was before the election, by the way, 69% anticipated modest economic growth. 35% reported job security. 38% planned on delaying retirement, and less than half said they pay great attention to their account balance. So nothing else in their 401k. The account balance alone, less than half of them said they didn't pay attention to it. So clearly work, back to that comment earlier about getting these folks engaged. Overall expectations of the next 12 months, as I said, total DC, 69%. Folks in B were a little bit more optimistic than K, is sort of what this graph is telling you. Job security, total DC is up over 12 and up over 10, but still only at about a third, which is what I mentioned earlier. Considering delaying retirement, 457 folks seem to be the most pessimistic. They were the most thinking about delaying. K was probably the most optimistic, and B was closely following behind. Reasons for delaying: need to save more, weak economy, Social Security might go bankrupt, too early to retire, need to pay down debt, and what am I going to do about health care? I think those ones in the middle kind of lend themselves to some of this holistic services that are kind of coming on the market. That'll help them figure out what's going on outside of the plan maybe more easily, but I don't think we should be sort of swayed and kind of chasing the shiny ball. That's a feature functionality. Got to get people in the plan and engaged to even use those tools, right? And then this was where we are at the end. So enrolled in auto features. Just draw your attention to the far right. Total DC was 45%, and auto step up was the lighter percentage, was 39%. So just here to say there's more opportunity to drive auto enroll. Our research tells us down market in particular, it might be available to the plan sponsors, but participants don't know it and don't utilize it. It's just another tool to be triggering, especially for those that aren't contributing, get in the plan, and then work to keeping them engaged. If they're not in the plan, it doesn't much matter. So Sorry for the speed and the data overload, but I think that's it for now.